Hey, Jim Schlexer from the CEO Project. You know, when you put the debt on your business, you did all these careful calculations and it was very manageable, right? It was a correct amount of debt. But now you're in a situation where the company's under a little stress. Maybe we've missed some sales forecasts or missed some profitability targets. And now you have too much debt on your business for the profitability of the organization. Well, what do you do in that circumstance? I've got a couple of ideas you may want to consider. Some you may not like, frankly. But the first one is to go talk to your lenders. There are normally covenants on the ratios that you have to hold of profitability to debt service. You need to go talk to them. And one option, and particularly when it's a generally negative economy, a lot of people are going to talk to them and ask for some level of relief. In other words, if we're allowed to have 3 times earnings divided by debt, maybe we should go to 3.5 for a little while as we get through this difficult period. They'll charge you for this. So it's not going to come for free, but many times you can be successful if you've been regular about paying your obligations and, in fact, you're able to do it with your cash flow. So a renegotiation of the debt with your existing lender is option number 1. Option number 2 is to go find another lender. There are a variety of flavors of lender out there, some that are more liberal in terms of their terms and some that are more conservative. You may find yourself that when things were good, you went to a conservative bank that might have somewhat lower rates. And so the ratios that they're enabled, the covenants that they're willing to accept are more strict. There are other lenders that might have a slightly higher rate who are willing to accept larger covenants. And if you're under stress, this is actually what you need more than a lower rate. So you might have an opportunity to move the debt to another lender who has better covenants, better regulations around the debt at a slightly higher interest rate. The third option, because these issues are around equity to debt, in other words, you don't have enough equity for the debt you have, is to bring in equity. And that may mean just a pure cash infusion. Sometimes, as the owner, we'll flow money back into the business, money that we took out previously, in order to stabilize the balance sheet for the benefit of the bank. And banks love it when there's money on the balance sheet because if things go sideways, they can just grab it and they're happy about that. They don't have to sell a building or something. So that's the third option. Fourth option is to sell part of your company. Now, it's not the greatest time to sell part of your company. This is why I talk about part of your company, not the whole company, although that's maybe an option. Because by selling the company, you're going to bring capital, or selling part of the company, you're selling equity in the company. That's an opportunity to bring cash into it, which again strengthens the balance sheet in a way that's positive for the bank. So that's certainly something to consider. The fifth option is to consider customer financing. Well, what do I mean by that? Many times customers are paying you in 30, 60, 90 days. There's an opportunity when cash is tight and you're trying to satisfy the bank to try to pull in those payment terms, maybe to 30 days or even 20 days or even cash in advance. We've had a number of companies that have very successfully changed their terms where they get half of their payment up front when the order is placed and half after 30 days. You can't imagine how good this is for cash flow and for the bank to satisfy those obligations. And the sixth option is not a desirable one, but if you really can't find a way out, you can't renegotiate the debt, there is an opportunity to go through a bankruptcy. Now, some people say that's a horrible answer, and nobody wants to go through a bankruptcy, but there is an opportunity to do it in a structured and managed way so that on the other side, you have a debt-free company. Potentially, you even have a significant ownership stake in it, and now you can go forward on that basis. I can tell you that I was in a prior industry where a number of my competitors did go bankrupt, and the fact that they had deleveraged all their debt made them formidable competitors. So if you're struggling a little bit with your bank, you're violating covenants, these are a couple of ideas that you're going to want to take a look at to see if you can get yourself out of trouble.